Most entrepreneurs think that to make more money, they need to sell more. But the truth is, more sales don't matter if your profits aren't increasing. I've seen business owners literally double their sales and making less money. The reason? They don't understand the business side of their business. So today, I'm going to show you a profit framework to identify your most profitable revenue streams so that you can make more money while working less. Who hasn't thought, if I sell more, I'll make more? Right? Makes complete sense. Because every entrepreneur business owner knows that without sales, your business will fail. But here's what's missing in that calculation: the cost of sales. For example, if your product or service costs more than the price you're selling it for, well, you're going to lose money. And the more you sell, the more you will lose. Take my book, The Next Level Entrepreneur. It sells on Amazon for $20 a copy, all right? Let's say the all-in publishing cost is $15, all right? So you'd say, well, George, you're making $5 a book, right? Wrong. What we didn't account for was all the time I spent in writing the book. I could have been out earning money, but instead I was writing the book. Well, I ran a calculation. It's very rough. It's just kind of a quick estimate. And I'd probably have to sell somewhere in the neighborhood of like 40,000 copies to probably just break even. It took years to write the book. Can you see how we have to consider there's hidden costs out there that go to making the product or delivering the service, okay? And that's what we have to account for. So the pushback I get from entrepreneur business owners who I say, look, just because you sell more doesn't mean you're going to make more. They go like, well, George, I'm profitable. Okay, that's good, but are you more profitable? Well, they don't know. They never even thought about calculating that. So they just blurt out, I've heard this so many times, well, I should be. You should be, that's true, but are you? So I know you guys like to go deep on this stuff, so let's get into the calculation of this, because that's the key, honestly, to growing your profits exponentially. First, let's orient to what these entrepreneurs are telling me. You know, they're profitable. Okay. Well, what do they mean? All right. What's the calculation there? Well, all they've done is take all their revenue, subtract all their expenses, and they're calling that profit. Okay. It's actually called net income or net profit, or we can say the bottom line. Okay, so it's all those things, but it's when all the dust settles, that's how much you made. But here's the deal. They could be making a whole lot more money if they track their gross profit. So what's gross profit? It's the same revenue, subtracting all the direct costs to generate that revenue, and that's gross profit. And gross margin is the percent. So gross profit is stated in dollars, and you take your gross profit dollars, you divide it by your revenue dollars, and that percent is your gross margin. So that kind of orients you, all right? So now let's dig into the key thing, which is the cost of sales. I think there's basically three categories: materials, labor, and then the sales cost. So let me break those down just a little bit. Materials are anything that you spend to manufacture the product, if you're making the product, or if you're retail, for example, it's your cost of goods. So it's what I paid for the item, and then I mark it up and I sell it. And there's all sorts of little things that are gotchas in there, like shipping, for example, would definitely be considered a cost of materials. So you've got to make sure you get everything in there. Now the trickier one is direct labor. Okay, so direct labor is the direct labor to either make the product or deliver the service, if it's a service. What could be tricky about that is, say you've got a person and they don't spend 100% of their time delivering that service. They may spend 70% of their time delivering that service. We only want to cost the time they actually spend to that revenue generating service, okay? That way we know what it cost us to deliver that service, because understanding these gross profit costs are very critical. Trust me on this. So let's get to the next category, and that's direct sales expenses. So commission is a great example of this. Let's say I pay a 5% commission on whatever you sell, okay, on the top line revenue. Well, I would then take that same 5% and apply it as a direct cost to the generation of that revenue. See, what you're looking for is what did it cost to make and deliver that revenue? Similar kind of thing to commission or affiliate fees, where I might pay a 25% affiliate fee if you recommend my e-course, for example. So these are all the things that you can begin to see. These are direct costs. So we take these direct costs, we subtract them from the revenue. There you go. That's your gross profit. But this is only the beginning, because the key is understanding your gross profits if you want to increase your net profits. And this is how we're going to grow your business profits without increasing your revenue. So to help you understand this, I've created a simple framework. So this is the gross profit strategy matrix. And it's going to completely change the way you think about your revenue and actually view it. So this matrix is your entire company. It's all the revenue of your company. So what we're going to do is break your revenue down into these 4 quadrants. So let me orient you first to the matrix, and then we'll get into how do you use it. So on this axis right here is gross profit, and it goes from low gross profit to high gross profit. And then along the bottom axis here, it's revenue, and it's going from low revenue to high revenue. So let's start in this quadrant, which I like to call the working hard quadrant, and it's Costco revenue. So at Costco, you have to sell a lot to make money, and that's because it's high revenue, but it's low gross profits. And Walmart's the same way. So these would be revenue streams that are like Costco, where you've got to sell a lot, but it's at a low GP, and if you sell a lot, you're going to make money. All right. Opposite this quadrant is the working smart quadrant. I like to call this niche revenue. It's low revenue, so I don't have to sell as much, and I've got a high gross profit. So for example, if I sold $1,000 of revenue in this quadrant, I might only have to sell 1 or 2 items, okay? Whereas in the working hard quadrant, for that same $1,000 of revenue, I might be selling 10, 20, 30 items. Okay. This quadrant right here, I call the struggling quadrant. It's where you have faltering revenue because it's low revenue and it's low gross profit. All right. And it's a struggle. So opposite this quadrant is the powerhouse quadrant. It's like Apple computer revenue. So they sell iPhones, MacBooks, all that kind of stuff. And it's high dollar items. So it's got a high gross profit and they sell a lot of them. So it's high revenue. So that's the matrix with the 4 kinds of revenue streams, all right? And if you'd like a clean copy of this instead of having to read my handwriting, just click the link below and you can download a free copy. It'll help you in plotting this whole thing out. Now what we want to do is we want to list your revenue streams, okay? So make a list of all the different kinds of revenue streams you have. Hey, if you're small or just starting out, you may be thinking, George, look, I sell service. I mean, that's what I do. I have one revenue stream. It's called service. I would challenge you on that thought because I have a friend, he started a new company last year and it's a service company. So all of his revenue is service revenue. And he was like, yeah, I just have service revenue. And I said, well, wait a minute, let's look at this. Well, when we looked at it, there were different kinds of service revenue inside of this category he called service revenue. And in fact, to the point to where we started pricing it differently. So take a look, split things apart, because that's going to be very important. Now, what I want you to do is, like per my formula, go, okay, this is low gross profit, high gross profit. And you may, here's what I don't want you to do right now. I don't want you to get the accountant. I don't want you to get all deep into the weeds on whether this cost belongs as a direct or indirect expense, that sort of thing. Just simply guesstimate this. And you go, this is probably a low gross profit item. This is probably a high gross profit item. You may need to check a few numbers, but don't get too tangled up into all of that. Because what I want to show you right now and what I want you to do is more of a mindset. Because we got to get to the strategy part of the matrix. But you may be asking, okay, so George, what is low gross profit versus high gross profit? Can you give me a number? Well, I really can't because it's going to be dependent on your own business. Let me give you a couple of examples. I've worked with companies where their gross profit was 60, 70, 80%. Okay? Not unusual for a service company. Well, so 40% for these guys, or 50%, would be low gross profit. So if you're in retail, a 50% gross margin could be high and a 20% could be low. If you're in manufacturing, you might be, 25, 35% might be high, okay? You see what I'm saying? So it's relative to your business and what you're doing. The same goes for revenue. What's low revenue versus high revenue? You may go like, well, George, I'm not Apple Computer. I'm not selling billions of dollars. No, but you're selling something. So what are you selling a year? 100,000, a million? What are you on track for? And then look at it relative to that. So let's pick $1 million, all right? And you can just take zeros off or add zeros to your situation. So if you've got a revenue stream that's $500,000, and your total revenue is $1 million, that would be high revenue. So it would be on this side of the matrix. If, on the other hand, you're selling $50,000 of that revenue, it's going to be on the low end if your total sales are like $1 million. Now, notice this. This is a line continuum, both horizontal and vertically. So you're not just going to say everything's in the middle of these quadrants. It's somewhere on this line. So let's say you have $1 million in revenue. And so I'd say, well, the halfway point would be 500,000. And you go, well, I've got $50,000 of revenue, but it's pretty high. It's not. So you go, okay, well, we'll put it right here. And that's what I'm going to want you to do. I want you to plot on the matrix where your revenue is. And you go, well, we've got one that now, we're selling a lot of it with $300,000 or $400,000, but, it's low gross profit and it may be down here. Okay. So what I want you to do is plot things and you go, well, then we've got another one and it kind of falls right about there. So when you plot your revenue streams, it's going to become screamingly obvious what's going on. Let me give you some examples here, because I've seen companies where they've got a strong revenue stream here and they go, but we can't cut that revenue stream. It's our bread and butter. It's what we founded the company on. And you're like, yeah, but how much time are you putting into this? And I'll bet it's more time than this one. And if you spent more time on this one, you can start moving the volume up. And what would you rather have? A revenue stream down here or a revenue stream up here? I'll answer the question, up here. Okay. And same thing goes for here. We could push this guy further over maybe, or up, so we're making more profit on it. That's the strategy. Once you see where your revenue streams fall, you can begin to strategize. And this is how you make more money without necessarily having to increase revenue. So one of the things I like to do in my videos is periodically include a bonus tip, all right? So if you've got a revenue stream here, or let me put one over here as well. Let me tell you what's more than likely going on with you, because most entrepreneurs are going to be in the working smart quadrant, or that's where they want to be. So they're not trying to have really high revenue, but they want high gross profit. But they're not. They're down here. That's a pricing problem. Because I've seen this so many times where they're working smart, but they're pricing like it's Costco. But they don't have the volume, so guess where they end up? Right here. You see how this thing works? It's amazing. And so what you need to do is strategize. How do we raise the price to get it up here? Now, subscribe to the channel, because that's a whole nother video. I'm going to dive deep in and show you how to use the profit strategy matrix to price. Okay. And there's a whole lot to that. So if you subscribe, you'll catch that video when it comes out. And remember, click the link below if you want to download this as a nice copy to have. In fact, I recommend it so that you're staring at it all the time and thinking about your revenue streams. Check out this video right here, because I take this same strategy matrix and I apply it to your whole company. And so each quadrant is a company. This is great strategy stuff. And in the meantime, may you live truly free.